There are years where the economy behaves like a grown adult, and then there's 2008, when the entire financial system acted like a drunk guy in a casino at 3 a.m. Double it, triple it, borrow more. What could possibly go wrong? Spoiler, everything. That's the 2008 financial crisis. And whenever you hear someone explain it like, oh, it was very complex, just remember, Wall Street makes everything sound complicated on purpose. They slap a 12-letter acronym on a stupid idea so you feel like only they understand it, and so you leave them the fuck alone while they collect fees.
Yeah, boy.
So nah, we're not doing that today. I'm here to peel the fancy labels off and show you what actually happened. First, you have to understand the vibe before the crash. Early 2000s America had this one belief stronger than religion. House prices only go up. Not usually go up. Not go up long term. No, only go up. People weren't buying houses to live in. They were buying houses like Pokemons. Gotta catch them all. Buy house, price goes up, refinance, pull cash out, buy another house, repeat. It was like playing SimCity with infinite money. Banks love this belief too, because if prices always rise, then lending money feels safe even if the borrower is questionable. If they can't pay, cool, take the house, sell it higher, you still win. So the whole system started treating risk like it was a myth. But here's the problem. After a while, banks ran out of good borrowers. Normal person solution, slow down lending. Wall Street solution, lower standards until the checklist becomes a suggestion. We went from show us your income, your job, your assets, to just estimate it, to bro, just sign here and don't worry about the details. And then came the most unhinged product in the history of lending, ninja loans.
Ooh, that's a good one.
Ninja means no income, no job, no assets. Imagine walking into a bank like, yeah, I don't have a job, I don't really have money, and my net worth is a 2001 Honda Civic and a dream. And the bank goes, sick, here's a $500,000 mortgage. These were also called liar loans because everyone was basically encouraged to lie. Borrowers lied on forms, brokers lied to get commissions, lenders pretended not to notice because loans equals fees. And a lot of these loans had teaser rates. At the start, payments were super low so people could afford houses they had no business touching. But later, the rate resets way higher. So it's like a gym membership that's $9.99 today and then randomly becomes $900 a month next year. You can already hear the future screaming. Some mortgages were even worse. There were loans where you could choose a payment so tiny it didn't even cover the interest. Meaning your debt actually grew over time while you were paying.
What?
That's called negative amortization. That's not a mortgage, that's a reverse diet. You eat salad and gain weight.
I forgot to order salad, oh my god.
Now you might think, okay, but why would a bank do this? Isn't that suicidal? Here's the twist. Banks didn't plan to keep these mortgages. They were doing something called originate to distribute. Old school. Bank gives a mortgage, holds it for 30 years, cares if you pay. New school. Bank gives mortgage, sells it immediately, gets its fee, moves on. So the bank is basically the guy flipping a car with a broken engine, sell it fast, collect cash, let someone else find out it dies on the highway. Once banks sold the loans, Wall Street stepped in like, all right, time to turn trash into treasure. They took thousands of mortgages, pooled them together, and sold slices as bonds. These were mortgage-backed securities. If homeowners paid their mortgages, investors got paid. So far, sounds normal-ish. Then Wall Street got greedy and said, what if we take the risky pieces of those mortgage bonds, bundle them again, and sell that too? That's a CDO, basically mortgage lasagna. They sliced this lasagna into layers called tranches. Top layer equals super safe, middle layer equals kinda safe. Bottom layer equals, this is gasoline, don't light a match. Losses hit the bottom first, so the top looked protected. And because the top looked protected, Wall Street could sell it as safe, even though the CDOs were made out of ninja loans and people who thought interest rate was a suggestion. Then they went full mad scientist. They made CDOs out of other CDOs, and then synthetic CDOs, which didn't even need real mortgages inside. They were built from derivatives so people could bet on mortgage bonds without owning them. Think of it like this. Normal CDO equals owning a sandwich made of mortgages. Synthetic CDO equals betting on whether that sandwich makes someone sick. But you can have 20 people betting on the same sandwich, so one real mortgage default could cause losses everywhere, over and over, like echo damage. So the system wasn't just risky, it was copy-paste risky. Now here's the part where your brain should start getting angry. The rating agencies. Moody's, S&P, Fitch, these dudes were supposed to be the referees. Instead, they became the kid who gives everyone an A because they're scared of losing friends. They stamped these mortgage products AAA, the highest safety rating on Earth, same level as US government debt. But why? because the banks issuing the CDOs paid the rating agencies. And banks could shop for ratings. If one agency didn't give them AAA, they'd go next door and ask another. So the system was like, here's a box of explosives. Nice box. It's AAA. Thanks, here's your check. Okay, so now you've got millions of risky mortgages floating around the world disguised as safe investments, and everyone's holding them. Pensions, banks, insurance companies, even foreign institutions. It's everywhere. What finally lights the fuse? Two things happen at the same time. Those teaser rate mortgages start resetting higher around 2006 to 2007, and housing prices stop rising. So borrowers who plan to refinance into a new cheap loan can't. Payments jump, defaults spike, foreclosures rise, more houses get dumped on the market, prices fall more. The fantasy, housing only goes up, died instantly. Now enter the main character, Michael Burry. Burry was a former doctor running a hedge fund. He's not the typical Wall Street frat bro. More like a weird genius who reads 400-page mortgage documents for fun. While everyone was partying, Burry looked inside the mortgage pools and saw mountains of subprime, ninja loans, teaser arms, and resets coming soon. He basically said, this market is about to get smoked and nobody wants to admit it. He wanted to short housing, but you can't short a house like a stock. So he invented the play. He bought credit default swaps on specific subprime mortgage bonds. That's basically insurance that pays out if the bond defaults. Banks happily sold him that insurance because they believed defaults were impossible. It was free money to them. When defaults exploded, Burry was printing money big time.
That's why he's the GOAT! The GOAT!
He made around $100 million personally and hundreds of millions for his investors. Imagine being so right that the whole system breaks just to prove you right. That was him. Now on the other side, you had banks like Lehman Brothers walking around like, nah, we're fine.
What are you doing?
Me? Just hanging around.
Lehman was loaded with mortgage exposure and running on insane leverage. Leverage means borrowing a ton of money to buy assets. It makes profits huge if things go well, and makes death instant if things go badly. When mortgage assets started collapsing, nobody trusted Lehman's balance sheet. Funding dried up, and on September 15th, 2008, Lehman filed for bankruptcy, biggest in US history. That was the moment the financial world went, oh wait, banks can die. Credit markets froze. Banks stopped lending to each other because nobody knew who was holding toxic stuff. The whole global money machine jammed. And for example, AIG, this part is crazy too. AIG was a huge insurance company that started acting like a hedge fund, selling tons of credit default swaps, basically insurance on those AAA mortgage CDOs, thinking housing could never crash. It did crash. AIG suddenly owed billions in collateral and didn't have the cash, so the government had to bail them out. Because if AIG died, every bank holding that insurance would have gotten nuked too. And that's why this became global instead of just a housing thing. Because securitization spread American mortgages everywhere, but in a way nobody could track. Everyone owned pieces of the lasagna, and no one knew which pieces were rotten. So fear went universal. So what's the real lesson? 2008 wasn't some mysterious black swan. It was bad loans dressed up as safe products rated by conflicted referees, sold worldwide inside a system built on one delusional assumption: prices only go up. The crisis didn't happen because nobody saw it coming. It happened because most people saw it coming and still pretended it couldn't happen because the party was profitable. So next time you hear someone say, bro, it's AAA, everyone owns it, it can't fail, that's not comfort, that's history clearing its throat. Because if your entire system depends on one happy assumption, you're not doing finance, you're doing group prayer with spreadsheets. Subscribe if you actually want to know how money really moves. If not, go enjoy your how to make $10,000 a day from your phone reels. I'm not your dad, I'm just the guy translating the scam.